Alrighty, perfect. We're up and running. Good morning, everybody. Hope you had a great weekend. It is Monday, start to a new week. I apologize for last week. I actually had a emergency come up right before the meeting. Had to get out of the office, but everything is okay. All right, perfect. So we're gonna go over the news and we'll talk about rates, where they're at today and what we think they're gonna be at in the near future. So CPI came in, Consumer Price Index, and showed a huge increase compared to what the estimates were. Headline inflation and core inflation both shot up 0.4% from February to March. On an annual basis, Consumer Price Index moved up to 3.5% on the headline and 3.8% on core. So for those of you that know that are here with us, pretty much every single week, Consumer Price Index measuring inflation. It's a big reason why the Fed increased their Fed funds rate. Now, this doesn't mean the Fed will start to increase rates again, but it does mean that they could be waiting a little bit longer than expected to cut rates. The only thing that can cause them to cut sooner would be unemployment, which we know hasn't really moved much at all this year. Initial jobless claims, which is people filing for unemployment for the first time, has stayed steady in the low 200,000s at 211,000 last week. And continuing claims haven't budged either and are at 1.817 million, which has been pretty consistent with what we've been seeing pretty much all of 2024. PPI, which is wholesale inflation, rose 0.2% in March, and PPI has increased from 1.6% to 2.1%, which makes sense, right? With CPI increasing as well. Usually PPI is first in their increases and decreases over time before CPI, and is usually a decent indicator for future consumer price index numbers because, of course, if the businesses are paying more for their products and services, then that means that that's going to trickle down to the consumer eventually as well. So we've seen the producer price index, which is PPI, increase last month as well, and went up from 1% to 1.6%, and now up from 1.6% to 2.1%. So we're probably going to see another month of CPI next month showing in higher than expected. And that could be rough for us, kind of leading into, or pretty much already being in Q2. You know, my expectation at the beginning of the year was I knew that rates were going to stay elevated Q1. I thought that probably by late Q2, we would already kind of see them going down. The problem with that is we're technically not in late Q2, right? The problem with that is it takes time for these things to kind of manifest. You don't want to see rates kind of coming up because then in order for them to come down, they have to stabilize and then come down. So it could be probably closer to Q3 when we see that at this rate, unless something drastic changes, which we're going to be talking about. There is some news that came out over the weekend, but as of right now and as of today, which I'll show you guys the charts, we're really not anywhere near where we want to be. Mortgage apps were down 5% last week and are down significantly year over year at 23%. I think this year has started off being very, very interesting. We thought 2023 was the worst year, and 2024 might shape up, I wouldn't say to be worse, but it's putting up a good fight right now, which is not a good thing to say or laugh about. But I mean, to start off the year, it's been relatively true, right? Rates haven't really come down. They were stable for the first quarter, and now we see them trending upwards. And then, of course, mortgage applications haven't really risen. There was only one time this year where they were up 20%, and that was the first week of January, where everybody started off hot. And since then, week over week, we're seeing some down weeks for mortgage apps, and we're seeing them actually down 23% from this time last year, which 23% is a lot in and of itself. But to consider what last year was, where it was the lowest mortgage originations in a very, very long time, even worse than the financial crisis of 07, 08, puts into perspective what this year is shaping up to be as of right now. So something interesting from the CFPB, Consumer Financial Protection Bureau, came out last week too. So a few weeks ago, we discussed the current administration looking into having clients not have to worry about title insurance on refinance transactions, which makes sense, right? Because why are you going to get more lender's title policy if you've never changed title under your name? It's the reason why when a person does a refinance, their owner's title policy, they don't ever have to renew it because it's the same owner's title policy. It should be the same thing for the lender, right? There shouldn't be a renewed lender title policy, even if it's a new lender that is taking over that property. Not only because most of the time those LTVs are really low, but also the fact that the owner in this instance never really changed, right? So for refinance transactions, it makes sense. But they've announced they're looking at it for purchases too. They're analyzing current closing costs and fees to make sure they can monitor the amount a buyer pays at closing, which is pretty nice because it does, we have seen, especially within the past couple years with margin compression, people having to pay points most of the time, things like that, with higher closing costs kind of into these transactions. So for the CFPB to kind of be monitoring and trying to see what can be removed in order for the consumer to come out winning will ultimately help lower their closing costs, which, thinking ahead, right, could also help with them if they need to come out of pocket for buyers agents compensations, right? Which I know we spoke about this. We pretty much speak about it every single week. So I'm not going to touch it today just because I don't want to beat a dead horse. But just thinking about these different things that will help the buyer now could also help them in the future. So now with a wider war in the Middle East, you would think that U.S. bonds would open up well this morning. So for those of you that don't know, whenever there is war lingering, the majority of investors put their money into the U.S. Treasury because the U.S. always pays back and always pays their debts. So usually during war times, you'll see our bond market reflect really, really well, where people are purchasing bonds, which means that pushes that price lower. And it in turn pushes mortgage-backed securities higher, which lowers interest rates. To open up the day right now and to open up the week, we've actually had a pretty bad start. Average rates right now are in the 8s, and Florida Bond and eHousing, who very, very rarely change their rates, not hometown heroes, but Florida Bond specifically, they very rarely change their rates. No matter what's happening on the day-to-day, you have to see huge swings up or down in order for them to change. And they did so last week, and we'll probably do it one more time this week if we stay on this track that we have today. Where before we were at 6.75% on an FHA and VA with Florida Bond, and 7.5% on conventional. We're currently at 7% FHA and VA and still at 7.5% on conventional, but I can tell you it's most likely not for long. And what's good and bad about eHousing is, like I mentioned, they take a while before they adjust rates. That's on the downside, but also on the upside too. So when rates are getting better, they may take a little bit longer to reflect that on their website as well. This might actually be one of the first times in a very long time we see home prices stalling for a bit. Because while rates are coming up, I don't know if you guys know this, inventory is increasing as well. There is 25% more homes on the market right now than a year ago, which is about 100,000 more than last year. Last year we were at 400,000. This year we're at 500 something thousand. Currently, of course, this is nationwide, so those prices may not stall the way that they may stall nationally here locally, because there's still people always continuing to buy and sell real estate down in South Florida. But you could see a little bit of a slower market down here where those homes may take a little bit longer because sellers are they've waited long enough. And now they're trying to list their homes on the market and trying to get something else and something new. I saw it this weekend. I was at a home buyer seminar, and there was a bunch of people there that were already current homeowners figuring out what they can do with their property, which is very rare. That's like the second or third time I've seen that. Yeah, usually you're going to these seminars and it's more so first-time home buyers, and their sellers really trying to figure out what they can do with their properties, if they should sell them, if they should renovate them, if they should rent them, all of these things, right? So you're seeing more sellers list their properties, and if the buyers, you're seeing more purchases as well, right? Because more inventory means that the current demand of people that were out there are still looking. But if this trend continues, where there's more inventory and rates stay elevated, these homes are going to stay on the market for a little bit longer, which may stall pricing as well. Okay, so really quick, just want to show you guys how bad rates are here. I mean, I guess we're at the, I wouldn't say the bottom, but I haven't showed this graph in a very long time. So if you're an OG, which I see a couple OGs in here, you know what this graph is. If not, I'll briefly explain it. I don't expect you guys to understand these numbers. I'm just going to tell you good, bad, you know, so on and so forth. This is mortgage-backed securities. This is the actual chart on the 6.5% coupon. So a lot of people always ask me, you know, about rates. How do rates work? Well, rates are pretty much the same across the board. Okay. There are investors that buy that buy mortgages, right? The investors that buy mortgages is essentially Wall Street. Wall Street will basically say, hey, for a this interest rate, we're going to pay you X amount, right? And so what happens is,
Okay.
the higher the coupon, the higher the interest rate. So in this case, this 6.5% coupon and this pricing at 101.05 means that Wall Street right now is paying 1% for a 6.5% interest rate. That does not include any sort of charges or any sort of costs that the lender incurs for doing these loans. And of course, being able to package them and sell them. So you never really see a 6.5%, right, interest rate on the market, unless that lender is working for literally all in 1%, which means that you're not paying your loan officer out of this. You probably have a salaried person that's doing this, aka banks, things like that. That's usually why banks get slightly better pricing, because all their stuff is in-house. They're able to save those costs, right? Not that to say that we're not in-house, but that's more so how it makes sense. So right now at the 6.5% coupon, you have Wall Street paying 1.05% on these loans. And you'll see in this graph here, what I want you to just pay attention to are the lines that go across. Those are what we call floors and ceilings. And you'll see here, we've kind of come all the way down. Red is bad, green is good. So the higher this goes up, that means that the more Wall Street pays for this loan, right? So the lower that it goes, it means the less that Wall Street is going to pay for this loan. So in this case, we are pretty much right here at that 101.035 Fibonacci level, which is a good thing because we can bounce up here and come back up. But look how much we've lost. So if rates right here were at on average 7.5%, down here they're probably at about 8% this week. Okay, that's how much traction we've lost and how much we would have to gain to come up. And we'd have to pass how many lines? 1, 2, 3, 4, 5, 6, 7, about 7 ceilings before we can get back to the positive, which could take some time. The only time that rates have really fluctuated like a lot daily has been during COVID. And when the Fed stopped buying mortgage-backed securities and started running off their balance sheet, those are the 2 times that you saw rates shoot up and shoot down dramatically. Other than that, they're pretty stable and they take time in order for things to kind of go back to normal. So to see these big down days has not been good at all for us. So just keep in mind when we're sending these closing cost worksheets out, when we're talking to clients, rates have gone up recently significantly, and you see it there. You can read it online. It has to do with the inflation reports that came out last week. For today, I think it's really as well that the markets are not reacting as well as you probably would have anticipated with the war in the Middle East expanding with Iran and Israel now, right? They're not responding that well, so that's also not a good thing. Now, we do still anticipate them to get better towards the end of the year, right? It's just a longer process now because we're taking more and more hits on the way down than we were on the way up. That makes sense for you guys. Last thing that I want to kind of point out here too is do not forget 2 things coming up very, very soon. One is in May, new income limits for all the down payment assistance programs. They usually do it across the board. That includes Broward, that includes Dade, that includes Go to Housing. All of the AMIs get updated in May, late May usually, which means that they're probably going to have higher income limits this year for all those programs moving forward. So if we have a client and, you know, I mentioned that they weren't that they were above the income limit and they were barely scraping it, by May, they probably will be able to do it. It just depends. And then, of course, July is Hometown Heroes. So very similar to what we did last year. You want clients to start getting pre-approved and apply in May. so that way they get their pre-approval in May. They start looking. They have a couple weeks to look. Even if they go under contract in June, that contract is 30 days anyway. July, we lock in that rate and those funds for them, and they close in July. So they can start applying as early as May, technically as early as now, but they wouldn't be able to go under contract unless they're going to be waiting 45, 50 days, which depends on the seller. Okay. Do you guys have any scenarios, any questions, anything you guys want to run by any of the other realtors here at all, or even to me?
Mike, I have a question. Can you
Yes.
repeat that again in regards to the hometown hero, like the whole step that you just gave, a whole rundown?
Yeah. So Hometown Heroes is basically coming out in July again, right? So usually what we did last year is we started getting people pre-approved and ready in the middle of May, because you get that pre-approval going now in May. Let's say it's literally a month from today, right? Let's say it's May 15th. They have 2 to 3 to 4 weeks or even more if they really wanted to start looking, right, at properties. And then once you go under contract, that contract is for 30 days anyway. So they're going to be closing in July. And if they're closing in July, we'll still be able to lock in the Hometown Heroes for them before closing and still get them closed. So they can
Okay.
start as early as May. If they have some things that they need to work on that they're unsure of, we would suggest now. That way it gives them some time to work on that stuff.
Okay, awesome.
Since we're on the hometown hero subject, when does the hometown heroes funds run out? Is there like a deadline?
There's $100 million available. So last year they were gone. They came out in July. By late September, they were gone.
Oh, wow.
Yeah, that's about 3 months, basically 2.5 months, 3 months, $100 million flew. I don't think it's going to be the same this year. I think last year, it being such a hot commodity, everybody was talking about it, advertising it, running with it. There was a lot of people that were really trying to get those funds. I think the market has cooled down a bit from that. I mean, we've seen it in the data. I don't think it's going to be that fast, but I still think it's going to go quick. If it's not September, October, it gives maybe a couple other families some time, but realistically, it'll be gone in about 4 months, I think.
Got it. Thank you.
No problem. Anything else? Any other questions?
Hey, Mike, it's Anita. So the Hometown Heroes, the qualifications have stayed completely the same. Can you run that down again for us, too, please?
Yeah, good question. So yeah, being a first-time home buyer, minimum FICO of 640, and then being a full-time employee, which means having 35 hours of work weekly, or if you're self-employed, your CPA just basically writing a letter saying that you do this full-time, and you're obviously your business being registered on SunBiz. Those are really the 3 main qualifications, and then of course the income limits, which as of today is 144 in Broward, 155 in Miami-Dade, and that is going to change in May, like I mentioned. So those are pretty much the 4 basic qualifications. Any other questions? We do have a great relationship with Florida Housing. We had the funds from December ran out, I think, about a month ago. And even as recent as last week, we still had people closing with Hometown Heroes. Really because we had made some phone calls to Florida Housing. We had some people that didn't close for property reasons. And what we did was we basically just asked Chip and Sandy, the 2 main people for the program, Charles Smith, we call him Chip, and Sandy. Basically, can we transfer those funds over to these other clients that were under contract? And so we were able to help those 2 other clients with the down payment assistance funds because of it. So we had one yesterday, and we had one, I think it was last week or week before, if I'm not mistaken. I'd have to double check. But we have a great relationship with eHousing. So anything that you guys need when it comes to Hometown Heroes or Florida Bond or something like that, we're usually able to communicate with them and get it done. there's no other questions. It is 10:23. We'll keep you guys updated. Anything that you need, you guys can reach out to me or the team. And if not, we will see you next week. Thank you all.
Thank you, Mike. Have a marvelous Monday.
Thank
You
you.
too.
Bye-bye.
Bye.